Volkswagen built the Beetle, the Golf, and one of Europe's largest industrial empires. Now reports say it may cut up to 100,000 jobs, halve its model range, and possibly close German factories. Did Chinese electric cars destroy Volkswagen? The real answer is more complicated and more important than the viral headline. First, Volkswagen has not already fired 100,000 people. Existing programs cover roughly 50,000 German positions by 2030. Management says another 50,000 roles worldwide may theoretically be required if costs cannot be reduced. Those extra cuts, and 4 possible factory closures, are not fully approved. So the accurate phrase is, up to 100,000 jobs at risk. Volkswagen is wounded, not dead. In 2025, the group still delivered 8.98 million vehicles and generated almost 322 billion euros in revenue. It remained Europe's largest car group and finished the year with 34.5 billion euros of automotive net liquidity. This is not an immediate bankruptcy story. But scale is hiding the damage. Operating profit fell from 19.1 billion euros in 2024 to 8.9 billion in 2025, a decline of 53%. The operating margin was only 2.8%. Volkswagen was still selling millions of cars, but every euro of sales produced far less profit after factories, labor, development, tariffs and restructuring. For decades, China was Volkswagen's superpower. The company entered early through local joint ventures, and became a symbol of dependable engineering and middle-class status. China supplied huge volume and valuable joint venture income. In 2019, Volkswagen Group delivered 4.23 million vehicles there. That success helped finance the wider empire. By 2025, China deliveries had fallen to 2.69 million. That is roughly 1.54 million fewer vehicles, a decline of 36% from 2019. The market itself did not simply disappear. Chinese buyers changed what they wanted, while domestic companies became better at delivering it. Buyers moved quickly toward battery electric and plug-in cars designed around software, connectivity, driver assistance, fast charging and aggressive prices. BYD replaced Volkswagen as China's top-selling car brand. Companies such as BYD, Geely, Xiaomi and XPeng use dense local battery and electronics supply chains, and can refresh products faster than traditional European development systems. Volkswagen remained strong in Chinese combustion cars, but that became the wrong race to lead. Its battery electric deliveries in China fell 44% in 2025. Then total group deliveries in China dropped another 36.6% year-on-year in the second quarter of 2026. The former profit engine was losing power rapidly. Volkswagen knew the car was becoming a computer on wheels, but execution was slow. Its software unit, CARIAD, reported a 2.4 billion euro operating loss in 2023. Platform delays held back important vehicles, including the electric Porsche Macan and Audi Q6 e-tron. In a software market, a late platform can make an expensive new car feel old on arrival. Volkswagen's response reveals the size of the gap. It invested about $700 million in XPeng to use Chinese platform and software capability for China. In the West, it committed up to $5.8 billion to a Rivian joint venture for next-generation electrical architecture and software. These may be smart deals, but they also admit that Volkswagen could not move fast enough alone. Europe created the second trap. Demand never returned to the world for which Volkswagen built its industrial base. During the 2024 labor negotiations, the company said Europe was missing about 500,000 Volkswagen sales a year, equivalent to roughly 2 factories. Germany still carries the wages, energy, maintenance and depreciation even when assembly lines are not full. Volkswagen now wants annual group production capacity near 9 million vehicles, compared with around 12 million before the pandemic and roughly 10 million more recently. It previously agreed to remove more than 700,000 vehicles of German technical capacity. Fewer cars across the same industrial footprint raise the cost of every vehicle, which is why factories and jobs are now central to the argument. Restructuring Volkswagen is unusually difficult. Half of its 20-member supervisory board represents labor. The state of Lower Saxony holds a blocking minority for major decisions, while the Porsche and Peach families control most voting rights through Porsche SE. This structure protects workers and communities from sudden closures, but but it can also make urgent change slow, political and expensive. Volkswagen is not one simple car company. It spans Volkswagen, Audi, Porsche, Skoda, Seat and Cupra, luxury brands, commercial vehicles and trucks, with overlapping platforms and thousands of variants. Management says group overhead is about 20% above comparable companies. Its new plan may halve the model range and cut variants by up to 75%. An empire built for scale became expensive complexity. Then a crucial profit pillar failed. The group's sport luxury operating result, dominated by Porsche, fell from €5.3 billion in 2024 to only €100 million in 2025. Weak Chinese luxury demand, American tariffs, slower electric adoption, and an expensive product strategy reversal all hit at once. Volkswagen lost the cushion that once covered problems elsewhere. Some of 2025 was exceptional. Volkswagen says operating profit, before special items and American tariffs, would have been €17.7 billion, not €8.9 billion. But temporary charges do not explain everything. Lower China volume, excess capacity, slow development, and group complexity remain after a tariff changes, or a restructuring charge rolls off. Those are structural problems. Dieselgate did not create BYD, but it weakened Volkswagen at the worst possible moment. Fines and compensation have exceeded €32 billion, while trust suffered. More importantly, the scandal exposed a culture where scale and technical prestige could hide poor accountability. Volkswagen then had to fund an urgent electric transformation, while still carrying a business built around combustion engines. The Chinese challenge is no longer confined to China. In the first 5 months of 2026, BYD registrations across the European Union, EFTA, and Britain rose 145% to more than 135,000. Chery grew even faster. Their shares remain much smaller than Volkswagen's, but their growth forces lower prices in VW's home market. There is a credible recovery case. Volkswagen's global electric deliveries rose 32% in 2025. In Europe, its electric sales increased 66%, and the group claimed about 27% of the battery electric market. It is localizing development in China, working with XPeng and Rivian, preparing cheaper electric cars, and simplifying the organization. So Volkswagen is not ancient, dead, or being killed by one Chinese rival. The competitive advantage moved from engines, manufacturing scale, and brand heritage to batteries, software, speed and cost. Volkswagen must rebuild around those new rules while carrying the factories, workforce, and bureaucracy of the old rules. The 100,000 job number is not the story by itself. It is the potential bill for being late.